Clearinghouses are at the forefront of global regulators' efforts to bolster markets against systemic risk. They've sometimes been labelled nuclear power stations, necessary but too big to fail. Why? After 2008, the G20 focused on derivatives as they introduced leverage into the financial system. Policymakers wanted more standardised over-the-counter derivatives, normally traded between banks with little backing for trades, to be processed through clearing houses. The attraction was that clearers managed counterparty credit risk. They worked as normal at the depth of the crisis, preventing it from spreading. Now, these venues stand between two parties in a deal, ensuring it goes through if one side defaults. And indeed, we're moving into a cleared world now, dominated by 4 clearing houses run by CME Group, Intercontinental Exchange, LCH ClearNet and Deutsche Börse's Eurex. But does this new world make it a safer place? Risk on financial markets has sometimes been compared to energy. It cannot be removed, merely transferred from one entity to another. Now, in theory, clearing means a simplified trading landscape. The clearinghouse makes sure there is sufficient collateral behind derivatives for trades and for credit risk. Now, this was the old world, and this is what is moving to the new one. But it looks very neat, but regulators, users and banks like asset managers worry about what happens if that red dot in the middle implodes. Does everyone fall into trouble, like climbers roped together on a cliff face? It's important to note that the number of clearinghouse failures in history is low. Even so, there's a greater focus on how clearinghouses work. Well, what happens if one of the clearing members, a bank like Lehman's, actually defaults? Well, here's how it works at Eurex, but the others are very similar. Now, this is known as a default waterfall. It starts up here, and you go through various lines of defence until you get to here. Now, first of all, the clearinghouse uses the margin put up by the defaulter. Once all that has been exhausted, it then turns into a mutual fund of contributions by other members and the clearinghouse. It's a very mutualised system of risk management. Now, regulators have sought to bolster various parts of this waterfall and test the scenarios and noted market panics of the past. In addition, banks can also sit on clearinghouses' risk committees and review new products for clearing, new memberships, and manage any credit risk that comes into the clearinghouse. They're also responsible for protecting the integrity of the guarantee funds. Regulators oversee the system and collective responsibility rules. And yet, there are frequent concerns about this new era. For a start, this is only one clearinghouse. In reality, there are dozens all linked together because the counterparties, the banks, the asset managers, are the same institutions. Now, some banks, notably JP Morgan and Citigroup, say that clearinghouses have insufficient cover here, and they want clearers to contribute more to the mutual default fund, increasing clearers' so-called skin in the game. Now, that's been strongly resisted by clearinghouses, in part because they argue it lowers the incentive of banks to manage their own risk, and it also brings higher risks for the clearinghouse. Now, also impacting this debate are new Basel capital rules, which have made it more punitive for banks to do derivatives trading. Now, more skin in the game effectively gives the banks greater capital relief on their balance sheet. Many asset managers and corporations will also be required to put up collateral for derivatives trading for the first time. Now, this could be very costly for them to find, especially if a bank cannot offer much credit. Higher standards may be, but few are willing to pay for it. Global regulators are also turning their attention to this area. What exactly happens if the money runs out? Now, regulators are looking about whether a distressed clearer could take money from here, or possibly even here, to keep going. But it affects banks and their customers differently, and it's creating a very fierce debate. Moreover, the push to clearing has brought increased operating costs for brokers, reducing their potential margins for profit. Delays have made it uneconomic for many smaller players, and large ones now dominate, as you can see. So a large failure could have systemic consequences. Are there enough other big ones around to be able to shoulder the burden? Furthermore, could clearers even amplify stressed markets? Their risk models are pro-cyclical, meaning they require more margin for derivatives portfolios during times of market stress. That's also the most difficult time for traders to find the stable liquid assets they need. So there are growing calls for standardised global stress tests. Unfortunately, too big to fail requires constant vigilance.